You know that feeling, right? Some big economic news, like an inflation report, is about to drop. The seconds are ticking down, the screen flashes, and then boom, it's just total chaos. The market shoots up, then dives down, all in the blink of an eye. For most people, it's just a wild gamble. But for the pros, it's just another day at the office.
So how do they do it? How do the pros actually trade the news and not get wiped out? Well, you can forget that image of some frantic trader sweating and guessing which way the market's going to jump. The reality is, it's a lot more disciplined, way more structured, and honestly, a whole lot cooler than that. See, here's the first big mindset shift. An amateur sees a headline like this and tries to predict what's going to happen next. But a professional, they see these events as catalysts for volatility, not as a crystal ball. The whole point isn't to guess the inflation number. Nope, it's to focus on how the market reacts to that number. That's the real game right there.
And this is what that reaction looks like. Just a violent, messy, emotional mess. I mean, look at these huge price swings. To an amateur, this is pure noise. It's terrifying. But to a professional, this is the exact environment where their plan starts to kick in.
And it gets even more specific. For big reports, like the jobs report, pros have a golden rule. Bond yields have to lead the way, okay? Think of yields as the market's gut check on the economy. If stocks start ripping higher but the yields aren't moving with them, it's a giant red flag. The pros call that an illegal move, and that one simple rule is their shield against all this noise.
So what is this defense? It's a playbook. It's what they call a global macro event execution template. And the secret, as you can probably guess by now, isn't about predicting anything. It's all about preparing for everything. It's about taking that chaos we just saw and turning it into a structured, manageable opportunity.
And this is the core philosophy. This is the mantra that holds the entire strategy together. Trade the structure, not the number. It literally doesn't matter if CPI comes in at 3.1% or 3.5%. What matters, the only thing that matters, is how the underlying market structure reacts. That's where you find the truth.
Now, this whole philosophy is built on a few key principles. First, macro awareness. You're looking at key price levels, not getting distracted by headlines. Second, something called binary legality. This is huge. It means a trade setup is either a go or a no-go. There is zero in between. This makes your process behavior-proof by taking your emotions out of it. And finally, you stick to one smaller-sized trade. It's all about discipline.
And that brings us to maybe the most important insight of all. For a pro, all the real work is done before the news even drops. While everyone else is waiting around to react, the professionals are already busy, running through a meticulous checklist to see if the market is even in a tradable condition to begin with.
Let's dig into that binary legality idea a bit more. The best way to think about it is like a pilot's pre-flight checklist. The trade has to check off every single box on a strict, objective list. If even one, just one, of those conditions isn't met, the trade is illegal, and you just don't take it, period, full stop. It's how you keep yourself from making those dumb, impulsive bets.
So here's what that looks like in the real world. Over on the left, you've got a legal trade. The primary driver is leading the way, liquidity is good, everything's moving in sync. Beautiful. But on the right, that's an illegal trade. It's confusing. The data's choppy, you're getting conflicting signals. If the market looks like that column on the right, the playbook says you do one thing: nothing.
So how do you know if a move is the real deal? You've got to watch the primary driver. Think of it like the market's quarterback. It calls the plays. For big U.S. economic news, like CPI or the jobs report, that quarterback is almost always bond yields. If yields aren't leading the charge, then any move you see in stocks is probably fake. For central bank news, it's going to be currency pairs. The driver tells you the truth.
All right, so you know your primary driver. Now it's time for the final pre-flight checks. Right before the release, you're on your chart, marking key price levels. You're making sure there's enough volatility to even make a trade worthwhile, but also that there's deep liquidity, meaning you can get in and out without a problem. These aren't feelings or guesses. These are objective, measurable conditions.
Okay, the prep is done. Now we enter the most critical, most dangerous period of all, what the pros call the kill zone. This is the 10-minute window where most amateur traders absolutely get destroyed. But for the pros, the goal here is completely different than what you might think.
The kill zone is brutally simple. From 5 minutes before the news drops until 5 minutes after, you do nothing. You don't put on new trades, you don't add to your winners, you don't try to fade the move. Your job is not to act, it's to observe. You're letting the amateurs and the high-speed algorithms fight it out while you just sit back, watch, and wait for the dust to settle.
So here's how that timeline breaks down. 5 minutes before, hands are off the keyboard. The moment the news is released, your eyes are glued to the primary driver, the bond yields, not the stock market. You even check to see if that first crazy 1-second candle stays within a certain range. If it's too insane, it's an automatic no trade for the day. Only after 5 full minutes does the kill zone end, and only then can you even start to think about whether a legal trade setup exists.
So, you did it. You survived the kill zone. You watched, you waited, that initial chaotic storm has passed. So, now what? Well, now the real work begins. Now you get to execute, based on what the market has just shown you.
Once that dust settles, the market is going to show its hand in one of 3 ways. Scenario A is alignment. This is the perfect world. The primary driver is leading, key levels are breaking, you've got a green light. Or you could get scenario B, a break and fail. The first move looks good, but then it just fizzles out. And finally, you might get scenario C, which is just nothing. The market goes totally flat. And in that case, the professional response is simple. You don't trade. You get up and you walk away.
You know, as we start to put all these pieces together, you can really see that this has nothing to do with some magic indicator or being able to predict the future. The entire strategy, from top to bottom, really just boils down to one single thing: unwavering, non-negotiable discipline.
And that discipline is enforced by ironclad risk rules, a hard deadline for your stop loss, moving your stop to protect your capital once a trade is working, and some big ones: absolutely never ever adding to a losing trade and never chasing the market after you've been stopped out a couple of times. These rules aren't suggestions, they are your armor.
So this entire sophisticated playbook really comes down to a simple 4-step process. First, you observe the market's initial chaotic reaction. Second, you confirm that the move is real by checking the primary driver. Third, you execute your trade, but only if the environment is legal. And finally, you manage that trade with absolute discipline. Observe, confirm, execute, manage. That's it. That's the whole thing.
And look, if you remember nothing else from this, please remember this one rule. If stocks are moving but the bond yields aren't moving with them, that trade is illegal. It's a trap. It doesn't have the big institutional confirmation that you need for a high probability trade. This one rule alone will save you from so many mistakes.
Okay, we've covered a ton here. Checklists, kill zones, primary drivers, all these risk rules. But what's the one single unifying idea that makes all of this work? What's the one core belief you have to repeat to yourself when the headlines are screaming and the charts are going crazy? It all comes back to this: trade the structure, not the number. The number is just the news. It's the bait. The structure, though, that's the market's true, honest reaction. And by focusing on the structure, you stop being a gambler who's betting on an outcome, and you become a professional who is executing a plan based on clear evidence. And believe me, that changes absolutely everything.